All right, here we go. Hold your ears, folks. It's showtime.
Live from sunny Southern California, it's the Real Life Trading, full year in the making. Ladies and gentlemen, it's the classes you've all been waiting for. Round 2 of Real Life Trading's totally free futures trading education. Oh my God, it is great to be back with you guys. How's everybody doing? Enjoy the couple weeks off? Good, glad to hear it. How many of you guys, type in a 5 if you got a demo futures account. Oh, 1, 55. How many did you get, Freddie? Oh, wow, look at you guys go. Awesome. 2 of them. Wow. All right. Well, looks like we've got a lot of futures traders. That's really awesome. For those of you who don't know, my name is Caryn. I'm here to help each of you reach the next level in your trading, not just in futures, but in all the markets you trade. Today is the beginning of the advanced futures trading classes. If you're new to futures or get lost along the way, I recommend reviewing the first 4 classes, all of which you can watch for free, like knowledge and education should be. They're on YouTube and the Real Life Trading website. Today, we're going to work on through a little bit of market auction theory, and I'm going to work on getting my tongue to work, a little bit of order flow, and learn some new charting methods that are going to help us see market structure and understand market dynamics with some just immediate clarity. I'm super excited, but before we get started, we must interrupt this program to bring you this word from the legal department. Trading is risky. Never risk money you can't afford to never see again. No one clicks your mouse but you, so click responsibly with full knowledge and personal accountability. Each decision to click that mouse is yours and yours alone. Okay, that was fun. We've had a couple weeks off, so let's do a quick refresher with a sprinkling of something new, sort of a warm-up exercise. Tonight's going to be pretty concept heavy, so before we start the heavy lifting, whirlwind review of some of the key things we learned in round 1. Ladies and gentlemen, what is the purpose of the market? Oh, frequent trader point for Jeremy. Yes, very good. The purpose of the market is to facilitate trade. I'm glad everyone can answer this question by now. And the more successful the market, as the erudite would say, facilitate trade. Make it easy for buyers and sellers to find each other and do business. The more deals that go down, the better. So what is the easiest way for the market to match up the most buyers and sellers, all with different ideas of value? Anybody remember? We touched on it in class 1. It's been a little while. I'll give you a big hint. We were talking about eBay. Yeah, exchange, you're close. All right, too much too soon. The auction process. We talked about eBay being a timed one-way auction. One seller, many buyers. The auction ends when time runs out or the item is bought. But if you want to turn around and resell the item, you got to start another auction. The futures market is a continuous double auction. That means the auction never ends and there are many buyers and many sellers. If you buy an item in the auction, you can immediately turn around, resell it in the same auction, or you can sell it first and buy it later. Okay, pop quiz. There is only one order type which is guaranteed to fill. What is it? Ooh, very good. Very good. Yes, the market order. Do you know what price the fill will be on a market order? Oh man, I love you guys. No, we don't know. All the other order types that day traders should use are price-based. Every new order is put in the order book as a resting limit order to buy or sell at the chosen price, and the order waits its turn behind the other orders that are in line at that price. Great. Are futures traders able to see all the resting orders in the book? Oh, mixed response. The correct answer is yes, we sure can. Anybody remember what chart we look at to see the book? We covered it in class 4. Aha! Very good. Here's the hint. Da-da! The dome. Let me grab the pen here. And let's see. We'll go with this pretty blue. Yeah, the depth of market ladder, also known as the dome. This column right here is price. Offers to buy over here. Look at them all. Offers to sell over here. Look at them all. Of course, they're a little cut off on this particular picture. Some domes will read bid and ask up here instead of buy and sell. If you ever get befuddled, just remember the two B's go together. B for bid, B for buy. So the other one has to be the sell. And what do we call this right here? Anybody remember the name for the current bid and the current ask? Well, Mark is the last trade. It looks like I got you guys, huh? It's called the spread. Let's see. Anyway, so at each price, we can see how many contracts are offered. And that tells us how many orders are in line and must be filled before our order. Now, we can cancel a resting order at any time, and so can everybody else. So a huge order in the book, like, let's see, who looks oversized and where's the mouse? Well, if you look at the price, $24.30 and a quarter, you can see there's 811 offers at the ask. That seems a little high for this dome. Down on the buy side, we've got 744 at 24.25. Those could get yanked at the last second. So never base your order purely on what you see in the book. I've got to find this. There it is. Okay. Sorry. My mouse disappears. It's the same color as the screen sometimes. So you never want to base your orders purely on the depth of market you see on the dome ladder, because those orders can always be canceled. There's only one type of order that can never be canceled. Anybody remember what type of order that is? Daniel, very good. Yes, the market order can never be canceled. Once you push buy or sell market, that's it. That order's in. There's nothing you can do. It's going to fill. And it depends how many are in line in front of you. Are market orders visible on the dome ladder? Yeah, market orders are not visible. Market orders are line jumpers. They jump to the front of the line in front of all of the resting orders. What you see on the dome are the resting orders. They're sort of a passive, like, when the market gets to this price, I want this many contracts. And if it doesn't get to this price, I don't want to play. So looking at this dome, if we were to enter a market order to buy, what is the most likely price of the fill? A market order to buy. I'm going to give more of you a chance to. Yeah, the correct answer is 28.5, 2428.5. if you enter a market order, you get the worst of the two prices in the spread. We're at 28.50 and 28 quarter here. So if you're putting in a market order, you get filled at the ask, provided there's no one in front of you. That's 28.50. So here's when everyone should get. If we enter a market order to sell, what is the most likely fill price right now? Market order to sell. Very good. Yeah, exactly. 28.25. Okay, so far so good. Let's talk a little bit about order flow. Okay. There's a lot of ways to see order flow without fixating on the dome ladder. Here's a couple that might be familiar to you. Level 2, not my favorite. But we can see when orders jump into the front of the line. You can see it happen right up here at the top. Suddenly, right up here at the top, there's the pen. Suddenly, there'll be somebody else jumped up in here or up in here. It'll just change. But you've got to be watching it to see it happen. And on your trading screen, the numbers are small. You got to watch it closely to see the changes. Frankly, I'd rather keep my eye on other things, like time and sales over here. This one lists all the fills, the completed transactions. You get the data a millisecond later than what you would see in level 2, but level 2 orders are only potential orders. Time and sales are the fulfilled orders, and the tape will require, that's what we call it sometimes, the tape will require less of your focus. You can just sort of watch the colors out of the corner of your eye, and unlike the dome and level 2, the tape never lies. Time and sales always tell the truth. There's no last second order yanks or spoofing in time and sales. No shenanigans. Time and sales is only real orders that filled. And you can use time and sales data to assess the current condition of the market at a quick glance. And by current, I mean like right this second, because it could change in another 10. So over here, and I've lost the mouse again. There it is. Over here, what's going on this chart? More buying or selling? What do you think, guys? Oh boy, okay, it's mixed. These are, I guess that wasn't fair of me, but I thought you would just sort of get it from the color. This is definitely selling. Everything's red. And this column here that tells you type, that means it was sold at the bid, which is which part of the spread, the high part of the spread or the low part of the spread? Yeah, the lower part of the spread. This is aggressive selling. People entering market orders willing to sell at the lower part of the spread because they think price is still going to go even lower. So how about this one here? How about this one? What do we think's going on this one in the center? Buying or selling? Yeah, I agree. Definitely not selling. Yeah, this is some buying. Okay, good. Okay, so what do you think about this one? Was that buying or selling? Yeah, exactly. Okay. I mean, it's kind of intuitive once someone explains to you. Okay, so level 2 doesn't offer this kind of at-a-glance clarity. Most platforms, the default colors are green for bought at the ask, red for sold at the bid. Occasionally, you might see 2 other colors, which would represent orders bought above the ask or sold below the bid, which is very aggressive. Now, there's a reason we focus on bought at the ask and sold at the bid, even though every transaction that occurs has a buyer and a seller. So technically, every contract that was bought was also sold, and every contract that was sold was also bought. But knowing if the contract was bought at the high side of the spread or sold on the low side of the spread or spread the bread. Anyway, it tells us more about trader conviction. And yes, each line there is one transaction. I don't know which line you're referring to when you ask column. The volume column says 24. That would be one trader. Each line is one trader. Yeah, that's one trade. Somebody bought 100 contracts at the ask, and my guess is they bought most of the big lots on there. Knowing if the contracts were bought at the high side of the spread or sold on the low side of the spread tells us about trader conviction, and I'll show you what I mean. That was Fred. Yeah, Frederick, ahead of everybody. So let's just sort of, what's the name for this little thing right here? But the bid and the ask? Yeah, spread. So, but trade is only executed at one price, right? It's either going to be at the bid or at the ask. When the bid and the ask are the same price, those orders get filled immediately and they're gone. And that price becomes the quoted mark, the mark price. But because the futures market is a two-way auction, the rest of the time, which is pretty much all the time, there's always two prices in play. The buy it now price, this one, the buy it now, or this one, the sell it now. This is my primary trading chart. It probably looks a little complicated to you right now, but by the end of these next 4 classes, everything on here is going to make sense to you. Here's time and sales. It's a little cut off, but that doesn't matter at the moment. What I want to focus on over here is my dome ladder. Give me a second. Let me simplify this real quick. All the prices in this price column are labeled in white, right? Except this black one right here in this orange box. That shows the last trade price, and we can confirm that over here. Here we've got, it says the last trade price was $99.75. Over here, time and sales, kind of cut off, but it says $99.75. So one was for 2 contracts sold at the bid, and the other was for 1 contract sold at the bid. So far, so good? Okay. All right. Well, all right, good. So now, where the market is at, can the market match any orders together right now? No. The answer is no. We're at a stalemate. We have buyers that are happy to buy at $29.75, and we have sellers willing to sell at $2,500. But the market can't move until someone is willing to either sell to these buyers or buy from these sellers. So the market's stuck. So just for the heck of it, let's pretend we're willing to buy at market and nobody else is entering any orders, and whatever market order we enter will be the first to get filled, and none of these buyers and sellers are going to cancel any of their orders. If we buy 1 contract at market, what price is our fill? Excellent. Yeah, $2,500. Will price move after we buy 1 contract? No, it won't, because remember, we're assuming we're the only ones trading this market for some reason. There's 6 here, 6 offered at $2,500. So if we just buy 1, there'll still be 5 sitting here waiting to be bought. What about if we sell 1 at market? Will price move? No. And what would our fill be if we sold one at market? Excellent. Very good, you guys. Okay, so how many contracts would we need to sell at market for price to actually move down? Yeah, 14 would work. Not this column. This column, bid, ask. 8. 8, 8, 8, 8. Look at you guys. Oh my God. Yeah, if we sell 7 contracts at market, what price is our fill on those 7 contracts? Right. So price didn't move. It's just still sitting there. It just makes the spread wider. The spread changed to 99.5 by 2,500, but the mark price didn't budge. But if we hit the sell market button for 8 contracts, we get our first 7 at 95.75 and our last contract at 95.5. Using up all the existing bids and then selling at the next lower bid, that will move price. So how many contracts would need to be bought to move price higher? All right, you guys are all over this. Yeah, it's 7. The first 6 would be filled at 2,500, the 7th, 2,500 quarter. So just from this little bit, we've learned about overflow. Let's take the quantum leap. On which one of these instruments will price probably move the fastest? ZN. Do I still have a pen? I do. Look at that. ZN. Come on, work. That's this one over here. It's only got, let's see, we got, like 1,000 to 2,000 orders on each side. Or ZB, which has like 100 to 200 orders on each side. Awesome. Awesome. You guys are quick. Yeah, the 30-year bond, ZB, is going to move faster. The thicker the book, the slower price moves because there's more orders to get through at each price. And for price to move, either all the buy orders or all of the sell orders have to be filled plus 1. Or somebody's got to yank and cancel them all. And a trade only occurs if somebody's willing to meet either the ask or the bid. So, just a little fun digression. Let's wrap up with time and sales. So, provided we're getting unfiltered tick data, meaning we're getting tick by tick data, no lumping, clumping, or dumping, then each one of these lines is one transaction. So that means this is one, come on, pen, this is one transaction, this is one transaction, one transaction, one transaction, one transaction. One transaction means one trader. So this guy here, what do you think? Is that bigger money or little money? Yeah, looks like bigger money to me too. Now, it's not that the risk makes me think it's bigger money. It's really the margin. And my guess is this person was involved in accumulating quite a position here, maybe that 10. But certainly most of these bigger lots, they're all at the same price. This is sort of the footprint you're going to see when big money starts buying. They don't just put in an order for 300 contracts or 2,000 contracts. They do it in little chunks. And this, maybe this is around, I'll estimate it at 300 contracts. That's only a risk of $4,000 per tick. But the margin required for 300 contracts, even at the smallest intraday margin I know of like $500 a contract, that's $150,000 in margin alone, plus the maintenance funds. So this might not be an institution, but it's definitely a bigger account. And who drives the market? Little money or bigger money? Yeah, bigger money. Yeah, only 4K per tick. So when you see larger lot orders like this over and over, especially in a range of like nearby prices, just a few ticks away from each other, that's the footprint of bigger money. And aside from just driving the market, they also have the power to defend their entries, which is equally important. Because if it's really bigger money accumulating a position, they're going to defend their entry. They're not going to let price drop too far below. And it'll get really boring for the rest of us. Sometimes it takes hours for them to get enough contracts and for the other side to give up and let price move again. And it's the same thing. If you see this size selling, that's valuable information. Now, time and sales all by itself, like anything, is not enough data to place an order. Don't just trade off what you see on the time and sales. We're going to get to other charts to look at before following the herd, which this kind of trading, I don't know if you can, anyway, before this round of classes are done. So let's do a quick test of our understanding. Let's see. Okay. Which of these two bright red domes is being driven by bigger money? The one on the left or the one on the right? Take your time. Okay, that took no time at all. Yeah, that's my take too. Definitely, I would agree. The one on the right, especially when there it is. Look at this. That's a big money footprint. They're adding some more. Yeah, down here, there's another 50. My take two. One on the right, red dome. So let's look at the green one. Which one's being driven by bigger money, left or right? Yeah, okay, great. Now, again, that doesn't mean buy or sell. It's just good to be aware of what bigger money is doing when we're looking at our other charts. Now, go with me on this. This is going to help you get a keener understanding of the auction process and the market in general. The low price or bid and the higher price, the ask. Buying at the ask, that's aggressive. Buying at the ask represents two kinds of orders. The first kind, traders hitting the buy at ask button, placing a buy order directly at the ask price on the dome in an attempt to get a fill right away. They're trying to jump in on momentum or close short contracts. But there's another kind of buy order that guarantees a fill and will only fill at the ask. And what kind of order is that? Mixed response. It's a market order. The first order I was talking about, when you place on the dome ladder, you click ask price to buy. That's a limit order. Market order, guaranteed to fill, but it'll fill it wherever the ask price is. It could move just in those few seconds it takes for your click to go through. But yeah, I was thinking of a market order. Those are very aggressive when you think about it. Buying at the ask represents one sentiment, and buying at market, that means fill me now. I'll probably get this price, but even if I don't, I want in now. Okay, let's, so if more traders are willing to buy on the higher side of the spread rather than wait their turn for a fill at the lower bid price, what does that tell you about their expectations for future price? Are those traders expecting the ask, buying at the ask, expecting price to move higher or lower? Yeah, higher. Would you agree buying at the ask is a more aggressive form of buying than buying at the bid? Yeah. That's why we focus on orders bought at the ask. They're more aggressive. Contracts bought at the bid are resting orders. They're passive buy orders. So orders that are sold at the bid are being sold at the lower price of the spread. And if sellers are willing to sell at the lower price of the two offers, what does that imply? I stumped you all. Okay, well, yeah, bearish, aggressive. That is exactly the word I'm looking for. If they're willing to sell at the bid, at the lower price of the spread, that's aggressive selling. They're market orders. Traders wanting to close or get short right now. So bought at the ask, sold at the bid. These are basic concepts behind reading order flow. And it's important. Is anybody confused? Because this is really a key concept to tape reading. Type in a 2 if you're totally lost. Okay, well, that should be long enough to find the number 2 on your keyboard. 1, Johnny Diego. Let's talk after class. Nargis, how many of you have I lost? Just the 2? Okay, you guys stay after school. We'll talk. We'll get more into order flow. You're not going to be lost you only missed the bid ask adding thing. We'll get there. We're going to get more into order flow. This is not the only time we're going to talk about it. Reading time and sales and distinguishing aggressive from passive trades. We're going to get into that when we trade some specific instruments together. For now, the big takeaway is when a trade is entered at the less advantageous side of the spread, it shows more urgency and conviction than trades waited for to get the better deal. Bought at the ask reveals more conviction than bought at the bid because the trader is buying at the higher price. Sold at the bid is more meaningful than sold at the ask because those traders are willing to accept a not as good price to ensure they get in or out of their trade. They're selling at the worst price just to enter or exit the market. These are aggressive market orders. Okay, so the strongest conviction is in market orders. Market orders say, fill me now, price is no object. Or traders can place a limit order to buy at the ask on the dome. So say you wanted to buy at the ask, you could just click right here. That's not a market order. That order will only fill at this price. If you put in a market order if you put in a limit order to buy 10 at 2,500, that's a 0. All right. You would get filled on the 6, and then 4 of your orders would sit here waiting for 4 more sellers to fill you. You would not get filled at all at the 2,525. If you hit market order to buy 10, you would take all 6 of these and 4 of these, leaving 16. Does that make sense? So that's the difference between market order and a limit market, a limit ask. Traders buying at the ask rather than market want a fill to jump in on momentum or close short contracts, but they want a little more control over the price. They're slightly less aggressive than the market orders. Like a market order says, fill me now, I don't care what it costs. And a limit ask or a limit buy or a limit sell on the dome right at the spread is kind of like a, please fill me now. But it's not the end of the world if I don't get in. These kinds of orders, these limit orders at the spread, they just, people want a little more control over the price. And there's nothing wrong with that. It's still a form of aggression. It's just not as aggressive as the market order. So let's take the final step. Why would anyone buy at the high side of the spread at the ask? I mean, if you could just wait your turn and buy at a better price at the bid, why not wait your turn? What do you think's going through those traders' minds when they decide to buy at the ask? Urgency, that's a good word. Yeah, because but need to, yeah. Okay. Those are all great answers. They're going to be doing one of two things. They're either going to be initiating a long trade in anticipation of price moving higher, or they're going to be closing shorts in response to the idea price is going to move higher. In both cases, they think price is going to move higher, but one person is initiating a trade and the other is responding to price action. Buying at the ask represents the belief, perception, conviction, price is going to move higher. And when enough of the money shares the conviction that price will move higher, it self-fulfills, doesn't it? If contracts keep getting bought at the ask, what happens? You know, you hit market, these are gone. Somebody else comes in, buys market, these are gone, these are gone, these are gone. You keep hitting market, this might take a little longer to eat through, but yes, up and away. You run out of sellers, and so it goes higher. Exactly. So if contracts keep getting bought at the ask, price moves higher. So, what happens if orders keep getting sold at the bid? If they keep being sold at the lower price, yeah, the opposite. They're willing to accept the lower of the two offers. That implies more aggressive selling, market orders, traders wanting to get their long position closed or get short right now. So bought at the ask and sold at the bid are the basic concepts behind reading order flow. Is anybody still confused? Algos do whatever they want, Frank. We'll get into that in the later classes. There's some games, and that's the shenanigans. Crystal clear. Love that answer. Okay, did that help the two of you that were maybe a little bit confused about buying at the ask and selling at the bid? Yeah, awesome. Oh, I'm glad to hear it. Okay, all right. We're going to practice this more. Don't freak out. And for now, the big takeaway is bought at the ask. That's aggression. Sold at the bid. That's aggression, because they're taking place at the aggressive side of the spread. Now, each completed transaction comes across the tape, one by one as the orders are filled, tick by tick. And in this instance, what is the meaning of tick? What kind of tick am I talking about? Am I talking about? Okay. One trader, Bill Myers, rocking it. Exactly, Tim. Very good. Yes, one tick, one transaction. Now, why does it matter if we see each transaction separately or if they're all lumped together? I kind of showed you already. It lets us see what? Yes, the size. Big money. Exactly. Without time and sales, we don't know what's going on there. Now, let's take a moment to talk once more about data, and then hopefully I will hold my peace for the rest of the classes. But this is important. Not all data feeds supply the same information. In fact, some of it isn't even complete. Now, I have nothing against getting something for free. I'm teaching these classes. But when you're getting free data, please make sure you're getting the data you think you are. A lot of the multi-purpose brokers filter ticks to promote platform efficiency. Now, I know for a fact Thinkorswim filters ticks, and that's not all. Toss lumps orders. They fail to show if transactions took place at the bid or the ask. Traders using free data are often missing valuable information, not just in the time and sales window. But for example, here we have Thinkorswim side by side with TradeStation. Now the TOS, time and sales window colors, trade green or red. Those are green or red based on price, not by order type. So a green bar in the Thinkorswim time and sales tells you price ticked higher, and a red bar tells you price ticked lower. As a result, you have issues like what you're looking at on the screen. Over here in TradeStation, now these are the exact same time. These orders sold at the bid, exact same, they're the same orders here. Same price, same time. Here, look, 16:22:29. This is 4:22:29 p.m. That's the same time, 170, one at the bid. These are the exact same trades. So which one of these tapes is right? Which one's correct? Which one can you trust? Yeah, well, here's the really sad part about this. They're both correct. Because it's kind of a trick question. Remember I said Thinkorswim changes the green or red only when price ticks higher or lower? Well, price didn't change when those orders were sold at the bid. So price didn't change. The toss time and sales window, it stays green. But is that but are they providing useful or misleading information? My humble opinion is at best it's kind of misleading. It's not very useful. I'm sure there's a disclosure somewhere detailing the Thinkorswim method of providing time and sales data, but I mean, seriously, who reads all that fine print? Type in a 1 if you've thoroughly read and understood every single disclosure on your broker's website. Yeah, and type in a 2 if you haven't. Yeah. Yeah, exactly. Your Honor, let the record state that the majority of traders in this room do not read all the legal mumbo jumbo on a broker's website. And I'm thinking that's pretty common. But if you're using the TOS, Thinkorswim, how are you going to see when the market starts to turn? You can't see the aggression of one side or the other. So you're not going to see when one side overcomes the other. So all I'm saying here is what you don't know can hurt you. This is all stuff I've learned the hard way. I'm trying to save you from that part of the learning curve. So the better question to ask is not which tape is correct. It's which tape provides the most useful information. And in that case, I would say TradeStation. So you tell me, is a futures trader that relies on Thinkorswim's filtered tick data trading at an advantage or a disadvantage? Yeah, it's a bummer. It stinks on ice. And the worst part is most traders using the platform don't even know it's happening. And if you think I have a bone to pick, you're right. If you're going to trade futures, you need the best data you can get. That's what everyone else making money is using. Don't let your data feed put you at a disadvantage. Trading's hard enough. Find out if your data feed is filtered before you open the account. And while we're at it, I'll also remind you once again, ask if linked OCO orders, one cancels other orders, are stored and triggered on your PC or on the broker exchange PC. I mentioned last round, if they're stored on your PC and your connection is lost, then your trade is naked. But that's enough about that. Let's move on to more pleasant topics, shall we? Okay, what is the only negotiable part of a futures contract? Only thing to negotiate. Yeah, Good, good, good. Yeah, price. Price is the big question in every futures trade we make. What price do we buy or sell at? So how do we pick a price? What do we base our decision to buy or sell on? Anybody? The chart. Trend, alignment of stars. Wow, really, you guys? Are we that? Okay, well, I'm going to give you a clue to what I'm looking for, which is support and resistance. Our good old friends, support and resistance, based on previous prices, historical information. So, you know, I would say the closest answer to that was the chart. We compare current price to our expectation of the future price. And the reason we're making that comparison, measure our risk reward, yeah, all of that. You know what? I think just for fun, let's try something completely different. Somebody tell me, how much is this fancy upscale beach house worth? Look at this beautiful view overlooking the ocean. Looks like there's a little island you could swim to over there. What's this place worth? Type in your bids. It's in California, okay? We'll say it's in California. $1. Somebody doesn't like it. Okay. So, okay. So lots of different, near a muck slide. We're getting lots of different prices in here. We know the seller wants to sell it at the highest price, right? So basically, whoever offers the most money is the one who's going to get to buy the house, right? So do we agree that the house is worth the amount the highest bidder is willing to pay? As long as the seller is willing to accept that price? Okay, let's try to figure out how much that is. Let's pretend each of you, you're going to love this, each of you is pre-qualified for a $10 million home loan. And let's pretend this is the home you want to buy. So now type in how much you're willing to pay for this stunning upscale beach house. Whoa, 10 million right off the bat. 10 million, 5 million, $500,000. It's not let's make a deal, you guys. Okay, look at all these bids. It would take me forever to sift through all these, figure out who made the highest offer. I think we've got matching high offers. But let me ask you, I mean, how did you guys come up with those numbers? Did you just throw out random bids? Oh, we got a realtor in the house. What if the highest bid is way higher than the second highest bid and you could have got a better deal on the house? I mean, what if 10 million is above fair market value for the house? And what's going to happen when you want to resell and no one will pay you that much? You're going to lose money, right? Oh, Johnny Childs, ahead of the game. What if I tell you the roof leaks? How many of you want the seller to fix the roof? Okay. How many of you will fix the roof after you buy the house, but you want the price reduced? Okay. See, now we've got to negotiate. We got to talk, and there's all these bids, and they're all jumbled together. I don't know who gets to buy this house. I don't know what that value of the house is because I don't know who's buying, or if the buyer could have gotten a better deal. And there's this leaky roof thing. It's just too many complications, and we've been through this. Do complications make it easy to conduct business and facilitate trade? Yep, they don't, do they? There's got to be a better way. I've got a crazy idea. Why don't we try an auction? An auction's a sale where all the terms of the sale are preset. The only aspect of the sale to be determined is the price. Sound familiar? Okay. Ba-da-ba-da-da. So anybody here been to a live auction? Type in a 2 if you've been to a live auction. Oh, wow. Look at you all. Whoa, more than I thought. Okay, well, just courthouse steps, just in case there's some people here who haven't. First of all, let's go over the rules. Terms of sale. If this house was a futures contract, this would be the contract specifications. House is sold as is. Buyer must take possession in 1 month. That's the expiration date. To qualify as a bidder, you must put $10,000 on deposit with the auctioneer. That's our performance bond or margin. Minimum bid, $100,000. That's our tick size. Also happens to be our tick value. So we're going to use the auction process to discover the value of this house. That's price discovery, finding value through competitive open bidding. Now, this will be a one-sided auction that will end on the highest bid. One-sided, we've only got one seller, and we've got all these buyers bidding. But the auction is complete when the highest bid is accepted by the seller and a binding contract is created. Let's do this. Okay. So each of you has plunked down your $10,000. Each of you is able to bid, and you have $10 million to spend. Now, let me show you the current estimate. Okay, the current estimate of current value and projected values based on similar sales in the area and past price movement. Think of this as the historical price information we would get from a chart. So, wow, similar homes recently sold for $1.5 million, and looks like the projection is for price to continue steadily higher. Wow, I wouldn't mind living here for 10 years and then sell the house for 4 times what that's a pretty good return. All right, well, let's get this party started. Minimum bid, tick size is 100,000. So each bid must be at least 100,000 higher than the last bid. So if you're willing to pay, if you're willing to pay 100,000 for this beach house, type in a 1. Zoom. Okay, let's type in a 2 for 200. Oh, we're already there. 3 for 300. Okay, here's a question for you. If instead of the house, your bid were for a futures contracts, tell me, what kind of orders are you placing? Yes, limit. Each of your bids is a market limit order. I asked 200 and you agreed. I asked 300 and you agreed. Those are market limit orders to buy at the ask. Now, there were a couple of you, Deborah, 18 million. You got a bigger loan than everybody else. There were a couple of you that jumped the line and offered more than the minimum tick increase. You guys were the market orders, the aggressive orders. Getting it? Let's go back to the auction. 4 for 400. Yeah, okay, 5 for 500. 6 for 600. Well, okay, you're bidding. I can't keep up with you, and this is going to take all night. Clearly, you all share a conviction to buy at this price. Why are you all so interested? Why are you willing to pay $600,000 for this house? Ah, you think it's a good deal. Right. We think the value right now is higher than the current bid because 100,000, even 600,000 for a house worth 1.5 million is a screaming deal, right? And by the way, anybody who didn't type in a 1 to buy this $1.5 million house for $100,000 probably needs to re-examine their investment strategy. So when price is perceived as below market value, there's a lot of bids and price increases pretty quickly. So type in a name for this kind of market action: heavy volume pushing price. And I'll give everybody a hint. I'm looking for two words. One starts with T and the other with M. Heavy volume, pushing price. T and M. Trend and momentum. Yeah, very good. Very good. Trend and momentum. Together, that's conviction. In an auction, when there are lots of bids at the asking price, what happens to the price? It keeps moving up faster and faster. Volume and momentum pushes price. In this situation, higher. Same thing in the futures market. If price is perceived to be below market value, right? If price is perceived to be below market value, the pace of the bidding increases and price rises as the bidders compete to get their hands on contracts at a price they think is lower than the future value. So price rises quickly. This kind of price action is called conviction. When price is perceived to be below value, the conviction of buyers willing to buy at the ask drives price back towards value. Well, the seller just told me no way he's selling this house for less than $1 million. So we'll have to try this auction thing again and start with the lowest price the seller is willing to accept, which is $1 million. So type in a 1 if you're willing to buy this. Well, we've already got a 1.2. Okay. It looks like a lot of you still perceive price to be below the future value. So let's increase the minimum bid. Let's increase our tick size to 250,000. So we've already got a bid for 1.2. Who'll bid 1.5? Who'll buy one? Okay, so about Brock 1.5. So okay, who'll bid 1.75? 1.75 million for this house. Frank. Okay. See how the bidding is starting to slow down now? Fewer of you are perceiving 1.75 million to be a good value. We might say those of you unwilling to buy now don't want to hold this house for the length of time it could take for it to reach this higher value. You guys that won't bid more than 1.75, you're the day traders in this auction. So type in a 2 if you'll pay $2 million. Catherine, they're just numbers I made up. Don't worry about the numbers. Yes, we have met the reserve. The reserve was 1 million. So we only have one bidder at 2 million. You guys think we're getting close to the top price for the house? The bids are slowing down, right? 2 million going once, going twice. Oh, we got 2.1. Okay. We have 2.1 from Dan. Oh, so we got people. Okay. Okay. We're going to call this done. So, good job. Okay. So we found a buyer at 2.1. Wow. That's amazing. That's actually the price I thought would be the closing price on this. Okay. So what happened in the beginning, all of you thought the house was a great deal, right? Tons of bids. Everybody's bidding when the price was below value. Lots of buyers eagerly bidding with conviction. But what happened? The seller wouldn't sell it, right? The seller said, no, that's too low. So we had to raise the price to accommodate the seller, right? Because if the seller won't sell, nobody's going to get the house for $100,000, right? It's just not going to happen. So as price got higher and closer to value, the conviction kind of subsided. Not as many buyers, you guys, thought there was a good deal anymore, and you weren't as interested. Not as many of you perceived price to be a good value now compared to your idea of when the future becomes now. And when price gets above perceived value, nobody wanted to buy, even though the seller would have been happy to sell. And you guys all formed your opinion about the value of this house from, oops, that wasn't supposed to happen. Okay, give me the pen. Oh, if you guys knew how messed up this stuff it can be to deal with. Okay, I've got a pen now. Anyway, you only got your idea of price from this chart. And we had one person questioning it. So now I'm totally lost because I screwed up. Okay. What if I told you all the other houses in the neighborhood were selling for $5 million? Would you be willing to buy the house for $3 million then? Yeah. That would be new information, changing your perception of value, and value being accepted as high at a higher level than it previously was. So, a lot of similarities to the market. Now we can go to the next one. Now, our little auction was an example of one seller, but lots of buyers. The futures market has thousands of sellers, thousands of buyers, an unlimited number of contracts, or, as in this picture, identical waterfront homes. The only difference between each of these houses, is they have different sellers, selling for different reasons and wanting different prices. Some are distress sales, foreclosures, divorces. Those would be like margin calls or stops getting hit. Maybe some of the sellers think they're getting out at the top of the market. They want to take their profits. Each has a different reason for selling. Each seller has their own level of urgency. Some will sell at any price. Some will only sell at a reasonable price. And some will only sell when they think the price is right. And each of the buyers looking to buy these homes or contracts has a different reason for buying. Some are looking for investment property. They're going to hold it longer term, wait for price to appreciate in a big way, and then unload it. That's kind of like bigger money loading up a position trade. Some are looking to just do a quick flip and turn the property around for a profit quick. Those are day traders. Some of them just, Lord help them, just lost their house in the hurricane maybe, and they need a place to live right now. They'll buy at market. Those are the margin calls, stops, momentum. Each buyer has a different reason and purpose for buying. Each has a different time frame for how long they want to keep the house. The contract. So each has a different idea of value. The buyers bid, the sellers ask, just like at an auction. Imagine that. So, pardon me, part of trading future successfully is understanding who's buying, who's selling, and why, to recognize the difference between the aggressive and the passive trade. In other words, we need to be able to assess the level of conviction that is currently moving price. Are the trades new initiating trades to open because price is outside the perception of value? So if it's a bargain, traders are buying, or it's overpriced and sellers are started selling, or perhaps a new price level is being accepted as value. Are the trades responsive trades taking place in response to price, like traders taking profits or their stops getting hit? Or are they initiative trades? Traders with conviction, getting in on a trade because they have to be a part of it. Which do you think is the stronger trade? People responsive closing of trades, or initiative, new trades? Exactly. I agree. I think under most circumstances, stronger conviction is in the initiative trades. All right. Good job, you guys. So the market's job is to facilitate trade, which means fill as many of those orders as possible. So let me ask you guys something about that last picture with all those waterfront homes. You think most of those homes are going to be bought or sold below market value, above market value, or at fair market value? Most of them, not all of them. Yeah. Fair. I got one above. Yeah. Yeah. Most of them, I think most of the homes on the market will sell around fair market value. Now, fair market value isn't always going to be the same price. It's going to change over time, just like any other market based on market conditions, right? Sometimes it's a buyer's market, like in a recession, or sometimes it's a seller's market, like when there aren't enough houses to meet the demand to live in the area. So fair market value of real estate changes based on the market conditions. Same thing happens in stocks, options, and futures. Now, let's get into the fun stuff. Do you think the market is going to do the most business when the buyers and sellers have similar ideas about price and fair value, or when they have wildly different ideas about price and fair value? Similar, wildly different. Where's the most business going to? Yeah, where the most business? They're going to? We said that fair value, right? Most of the business would happen at fair value. So if the buyers and sellers have the same idea of fair value, is that going to be more business, or when they can't agree on fair value? Yeah, when the buyers and sellers agree on fair value, when they have, they're kind of close on what their idea of price should be, that's where the most trade's going to happen. So the market moves up and down, trying to find those price levels where the most buyers and sellers, think they're getting a good deal or fair value compared to their concept of the future value, whenever that particular person's future may be. When the market finds an area of value, it's fulfilling its purpose, facilitating trade. It's operating at its most efficient, and the market will stay there as long as it can. It'll stay in that value area until one of two things happen. Either the market exhausts all of one side's orders and price has to move to find more buyers or more sellers, or new information causes the perception of value to change, and one side becomes so much more aggressive, it overwhelms all those passive resting orders that you see on the dome ladder, and it drives price to discover new value. Exactly, Catherine. When they agree, the market doesn't move much. So price naturally gravitates to areas where the most buyers and sellers agree. Fair value, right? Those areas are called, anybody want to make a guess? No? That's okay. They're called value areas. There's a lot of Grant's tomb kind of crap in here. So value areas, 70% of all market transactions will happen within a value area. And actually, it may even be higher than that. I'm kind of being conservative when I say value area. So let's see. Let's just draw in some lines here. Forgive my terrible line drawing skills. Where's Jeremy when you need him, huh? Yeah, this is a little one here. Yeah, I think we got a little something here. Let me switch colors on the pen. La 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 la. La 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 la. So maybe right here. And I like right there. I don't like that one much. Yeah. Boom, boom, boom. That's enough for now. So we have a lot of different names for these values areas. What do these look like to you? How would you describe this kind of price action? Type it in. What word would you use? Accumulation, yeah. Support and resistance, good, good. Yep, consolidation. This is oil. You are correct, Frank. Is that okay? Do we have objections to oil? Anyway, getting back to this. So balance areas. All of those answers are correct. Trading range, sideways channel, accumulation, distribution. We already know about value areas. We just have a zillion different names for them, but they all mean the same thing. At this time, the majority of traders believe that trade in that current price range is fair. compared to their idea of what the future value will be. And there is balance between the buyers and sellers within that price range. Value areas are price ranges where the most sellers and the most buyers agree on price. And as a result, that's also where the most business is transacted. What do we call these boundaries of the value areas? Those green lines, what do we call those? I put you all to sleep. Yes, support. And, they're sloppy, but vaguely it's support. And those red lines, what would we call those? Yeah. Exactly. It's support and resistance. So support and resistance is formed when a large number of buyers and sellers agree on value. Most of the sellers currently won't sell below these lines of, well, I don't know about this one. That's pretty bad. But sellers won't sell below these lines. It's just too low. It's too cheap. They don't want to let it go. It's like the house. He's not going to sell it for $100K. I'm not even going to bother. This is, I tried, guys. Sellers won't sell down there. And what happens above the red line? It's resistance, but what's happening up there? Exactly. Buyers won't buy. It's too expensive. So fewer transactions will happen outside of the value area. It's too cheap to sell at, or it's too expensive to buy at. Now, does the market want a lot of transactions to take place, or do they want just a few transactions to take place? Yeah, lots. So where's the market going to spend most of its time? At a price where there aren't enough sellers or not enough buyers, or in this value area where there's plenty of both? Yep, exactly, in the value area. Great, let me find my mouse once more. So, I think we've covered all of this. Yeah, okay. So, okay, now, there's two reasons for buyers to buy, and there's two reasons for sellers to sell. The first reason is the initiative trade, the aggressive trade, right? Opening a new trade because a directional move is perceived to be beginning. The second reason a trader trades, buyer buys or seller sells, is in response to price. In other words, closing a trade, either to take profits because the move is perceived to be ending, or their stop's getting hit, they're on the wrong side of the trade, and they want to avoid further loss. So that's in response to price. It's two very different kinds of buying. It's two very different kinds of selling. One's more aggressive than the other. The trick to trading well is to recognizing the difference between those two. And just stick a pin in that for now. We're going to revisit the difference in energy between closing at target and opening with conviction and taking out stops a little later. We'll get into it a little more here, but we're still in like the fledgling stage. So let's quickly review balance. Balance is the first state of the market. Buyers and sellers agree on fair value. That means there's a relative balance between the number of contracts that are offered at the bid and the ask within a particular price range. Balance is the market performing at its most efficient. It's the easiest way to get the most transactions to take place. And that is the purpose of the market. Get as many transactions to take place as possible. So the market spends most of its time, like I said, around 70, 75% in balance, otherwise known as a value area. Value area is the price range where the most traders perceive they are getting good value now compared to what they expect the future price to be. Now, at some point, the market will either run out of buy orders or run out of sell orders within the value area. And as the market exhausts the supply of bids or asks within the value area, or traders become unwilling to buy at the ask or sell at the bid, for the market to facilitate trade, it's got to probe outside of the value area to find a new level that will entice more market limit and market orders. Because some traders start thinking, I might be able to get an even better deal and buy just a little bit below this area. Or I might be able to get a little bit better price and sell just above here. So, or new information changes that area that is perceived as value, and then one side becomes way more aggressive. Now, there's only two states the market can be in. Balance is the first state of the market. 70% of the time, market is in equilibrium, balance between buy and sells. It's the easiest way to get the most transfer. That's the purpose of the market. So it's the first and most efficient state of the market. If it's called balance, what do you think the market's second state is called? Oh, boy, you guys are good. Yeah. Ooh, we got some smarty pants in here. Okay, yeah. Actually, haha, I had a funny joke. I was going to say the second state's called Idaho, but I'm kidding. You guys nailed it. Imbalance. The market spends about a third of its time in the state of imbalance. The rest of the time, the market is in what state? Ooh, I said that funny, so it came out weird. Balance or imbalance. Yeah, exactly. So if balance is agreement between buyers and sellers, and it looks like, oh God, I've got to do this whole pen thing again. Sorry, guys. So if balance is agreement and it looks like this, come on. If you knew what was going on my end, you'd be laughing too. So that's what does imbalance look like? Somebody squeaked it out earlier. What do you think an imbalance between buy and sell orders will look like? Yeah. The word I'm looking for is trend. Yeah. Trend. That's imbalance. Directional movement. The market has to discover a new price range where it can do what? What's the purpose of the market? Yeah, balance, facilitate trade, right? It's going to move until it finds a new area where it can facilitate trade. And what a coincidence. It kind of came right back to the same one, two. I mean, this is a tiny little one. It doesn't really count, but it could. Do that over and over again to the same levels. This trend is the process of price discovery, searching for the new level where the market can facilitate trade. When there is imbalance, one side is entering market and market limit orders, enough of them to use up all of the resting limit orders of the opposing side, right? Like we did at the very beginning, we started to see how many orders we had to put in to eat to the next price. Eat through the resting orders and get into the next price. That's what market limit orders and market orders do. Without those kinds of orders, the market wouldn't move because you would have a bunch of people sitting at the bid price and a bunch of people sitting at the ask price, and never the two would meet. So it's the market orders that move the market and the market limit orders. And on a trending day when the market limit orders are steadily above or below ask, and they leapfrog each other, the other market orders to get a fill and start paying above ask or below bid, the opposing side, the ones that are not going the right direction, start canceling their orders, which makes the market move even faster. It just keeps pressing price. It snowballs. And the resting orders that didn't get canceled in time, they get stopped out, which feeds the trend more. And even then, if everybody pulled their orders, never fear, because there's always plenty of those top and bottom pickers getting trapped on the wrong side of trend day, and their stops add more fuel to each directional move. On a normal trend, on a non-trend day, price will usually move towards size. And what that means, the heavier side of the resting limit orders. which we see where? Where do we see resting limit orders? Yeah, on the DOM. Okay, so on a non-trend day, the side of the DOM ladder with the largest number of contracts tends to be, not always, but usually, is the first direction price tests in when it starts busting out of value. Now, this is a funny thing to wrap your head around at first, but under most market conditions, price tends to move towards size. If there are more resting orders to buy than orders to sell, more resting orders to buy than orders to sell, should we expect price to go up or down? Okay, yeah, very good. Yeah, if there's more resting buy orders than resting sell orders, price will usually move down first and fill those buy orders. Now, if the buyers get aggressive and show conviction, they can push price back up once price comes down to them. But the initial move with a buyer-heavy imbalance is down. Okay, so a lot of people, well, I won't even go there because I don't want to confuse you. Okay, let's try the sell side. If there are more resting orders to sell than resting orders to buy, which will price usually move up or down? You guys are amazing. Yeah. Okay, I don't even know why I'm teaching this. Yeah, price tends to move towards size. If the imbalance is heavier on the sell side, price will move up to fill those sell orders. If the sellers get aggressive and show conviction, they can push price back down as price comes up to them. But the initial move with a seller-heavy DOM is going to be up. It's counterintuitive when there's more. You know what? I don't want to confuse you. That's how it works most of the time. So imbalance forces price to move in a direction. And what's another word for directional movement? Yeah, exactly. Trend is the word. All right. Very good, you guys. You bullish trend. Yeah, directional movement. Okay. You guys know this stuff. Well done. So trend is market imbalance. It's the result of a change in the order balance. It only occurs when the market exhausts all the resting orders, and to satisfy the incoming market orders, price has to move outside the value area to find more orders to satisfy the incoming market orders. This imbalance occurs for one of two reasons. The first is it just runs out of resting orders in the value area. They're all used up. The second reason, and the more forceful of the two, is new information. When new information changes the common perception of value, let me start that over. When trend is caused by a change in the perception of value, the market is driven pretty forcefully in one direction. And this is the powerful type of imbalance. When the market's driven so hard directionally that it's unable to go to size, and it spends nearly the entire day moving in one direction. Pullbacks on those kinds of days are quick, they're small. Traders trying to fade the moves get slaughtered, and their stops just feed the frenzy. Those are pure trend days. They only happen once or twice a month. But when it happens, the market is driven by size. It's not attracted to size. Size pushes the market away. So what do you think would qualify as new information that's important enough to influence people's perception of value? What kind of things would change perception of value? Well, yeah, news. And fundamentals is more of a stock thing. However, macroeconomic news would kind of be like fundamentals for the futures markets. Trump tweets, yes, I'm afraid sadly that's true. Global events, rumors. Oh, short sellers. Robert Mendez, very good. I was about to add one more idea to that basket, and I will call it big money. When bigger money enters the market, it doesn't matter if there was news or not. They're going to change everybody's minds right quick because they can drive the market directionally, and that's going to change the perception just as much as anything Janet Yellen says or any economic report. Big money is capable of forcing the market out of value and into the less efficient state of trend. Existing positions can get stopped out or hit their targets. Unfilled orders start getting canceled. New orders are entered heavily on only one side. That's trend. And it's great. Traders love trend, but it's not the market's natural state. The market only spends about like 20, 25%, maybe 30% of its time trending. So can we expect it to continue forever in a straight line? No, of course not. I mean, we discussed why not earlier, but real quick, it's easier to match buyers to sellers when they agree or they disagree on price. Yeah, when they agree, right? It's always easier when they've got a similar idea. And when they agree on price or value, is the market in balance or is it out of balance? Yeah, it's balance. So which is more efficient for the market, balance or imbalance, right? Balance is more efficient, imbalance less efficient. So trend, we know that's imbalance, and imbalance is less efficient, and the market's purpose is to be efficient and make as many trades as possible. So the market does not like to be in a state of trend. The market wants to find a place of balance and just cozy up and stay there forever. Price discovery is the market's least favorite thing, and one of some of the least productive days for the market. So if the current value area is no longer acceptable to both buyers and sellers, the market trends. Usually that leads to a previous value area where buyers and sellers agreed at some point in the past, like we just saw on the chart before. Okay. So depending on the kind of market day, the market will trade within one value area or bounce back and forth between 2 or 3 value areas, or it's going to trend all day and break through every value area in sight, all in an attempt to find where buy and sell orders will balance and the market can be efficiently. It's not going to trend forever. It's not going to stay in the value area forever. But the market's purpose is to find the area where the most transactions can take place. And often that's going to be in a previous value area. Now, this is nothing new to you guys. We're just talking support and resistance, but we're learning to think about those levels in a new way, in a way that helps us assess the strength of a directional move to make better decisions about when to take our profits, when to let them run, and when to get out of our position or reverse. But I'm getting a little ahead of everybody, and we're going to be looking at charts and the developing intraday market structure to assess trade probability all in the next classes. But we've got to get this theory under our belts. And with that in mind, pardon me, I've compiled a list of what I think are the relevant bits and pieces from, books and market scholars and all kinds of tidbits I've collected over the years, and created something I like to call the amalgamated laws of market dynamics. I can't take credit for any of these concepts, just for putting them all together and maybe for turning it into some plain, ordinary, everyday English here and there. I tried to credit the original sources just in case anyone wants to do more research. There's more to this thing, but I'm a believer in lots of little bites rather than one giant heaping platter all at once. So the first one, and these are in no particular order, they're all equally important. First one, we just covered, there's only 2 states of the market, balance or imbalance. Balance, buyers and sellers agree on fair value, meaning the market is trading in a sideways range. And it stays there until one side's resting orders are exhausted, meaning the number of orders are heavier on one side of the dome or the other. And there's two causes for that lopsidedness or imbalance. The first one, lack of interest on one side, just not enough resting orders to satisfy the other side's demands. Second, caused by a change in the perception of fair value, usually on some kind of news or the force of bigger money, causing one side to pull their orders and the other side to add. Both are types of order exhaustion, making orders heavier on one side and lighter on the other. Obviously, change in perception is going to have a greater influence than lack of interest. And it doesn't matter what the information is, it doesn't matter what we think price should do based on that information. Market doesn't care what our opinion is. Sorry to disappoint you. What matters is how the market reacts. Don't waste your time deciding if it's good news or bad news or what the response should be. All that matters is there's new information. Who is in control now? Where might that control end? In one-sided trade, only one side can be in control. Either the bulls or the bears are driving price. And whichever side is driving will continue to drive price discovery until price reaches a level that the drivers stop adding new orders. We call that exhaustion too. Or price discovers a place where, we agree this is a decent value now, and we call that balance. Or price reaches an area that coincides with an area on a bigger time frame where the swing traders and the institutions say, hey, I've been waiting for price to get here forever, I'm in. And bigger money jumps in, takes control, and drives price in the opposite direction. And that's how we get a reversal. So sometimes trend ends in a new balance and trades sideways for as long or as little as the orders last before trending again. And sometimes trend ends in a new trend, creating a V bottom or a V top. And that's pretty much market action in a nutshell. People agree on price until something changes their mind, then the market searches for the next price range where the most transactions can take place again, and it just goes full circle. So when the market trends, we ask ourselves, who's in control? How strong is their conviction? What price is that control likely to pause or end? And is that price an area where the market will create new balance or a short pause before the trend continues, or an actual stopping point where the market will regain balance and efficiency and have to exhaust orders again before it can start the process of price discovery? Or is it a price level where big money might be lurking and reverse the trend? Give me a second. I need a sip of something. All right. So how are we doing? Any questions on the two states of the market? Balance, imbalance? Everybody good? I put them all to sleep. Oh, there we go. Okay. Glad to hear it. So now, big money. That's a good segue into the next little law. The markets are fractal in nature. I've never seen such a concise statement produce so much confusion. The fractal nature of the market is the miracle that allows buyers and sellers to agree on value, but still take opposing sides of a trade because they have different expectations of future price. And this is just so much easier with an example. Let me see what I've got here. Okay, yeah. So here we have 5 different time period charts of the ES minis. We've got the weekly, the daily, the hourly, the 15-minute, and the 5-minute. And the area highlighted in pink on each chart is the entire week of July 18 through 25 of 2014. So every candle or series of candles in the larger charting period can be broken down into a series of candles in a smaller charting period, right? Each week will break down into 5 days, and the 5 days breaks into, I don't know how many hours it is, but you get the idea. You can keep breaking it down. And each of the smaller charting periods are going to have their own patterns and opportunities to trade trends between balance areas. And if the balance area has a sufficient range, I mean, we could even trade the range itself from top to bottom and bottom to top. So on the weekly, I'm sorry, you guys, the pen is really throwing me tonight. That's what I get for taking a break. Okay. So the weekly, just one spinning top of indexation. There's no trade on the weekly chart. Daily chart, yeah, you know, maybe there's one long trade, but the hourly chart, I don't know, oh, good, I marked them. There's like four short trades. There's even opportunities for short trades on the 15-minute, on the 5-minute. No matter what time frame we look at, though, the market is either balancing or it's trading in a range, right? Or it's in a state of imbalance. It's trending. So the weekly chart, you know, who knows? Maybe that's balance. There's not really enough info on the daily chart to really assess. Maybe it's probably in an uptrend. The hourly chart, is that imbalance or, boy, they sound a lot alike. Is it balancing or is it trending? Kind of a little of both, I think. But, I mean, you see familiar patterns in the hourly, right? I mean, come on, pen. I mean, this could be kind of a head and shoulders, right? There's a head and shoulders or multi-top. We're going to see patterns in all the time frames, and they're valid in all the time frames. That's the fractal nature of the market. So somebody going long on the 5-minute chart can be satisfying an order to sell. Oh my God, okay. Let me start over. The weekly chart could be balancing while the daily chart trends, and different types of traders are trading different charting periods. And that's why two traders can take opposing sides of the same trade and still believe they'll each be profitable. And they can both be correct. It all depends on the duration of their trade. Or in other words, how long it will be until that trader's future becomes now. It could be in 10 points, could be in 10 days, could be in 10 weeks. Which brings us to the next law. Hallelujah, because I just totally gobbledy that. Support and resistance. People buy something when they think the price is too low because they think it's a good deal. They think it's a good deal because they see value, and they think they can sell it in the future for a higher price. Again, that could be 10 minutes from now, 10 hours, 10 weeks. Where the future becomes now is going to be different for everybody. Now, we know there's buyers interested below this green line, right? We know there's buyers down here. Look at them all. They're buying. But what really is creating this support? Is it that the buyers are buying? Is that what creates support? Buyers buying? Oh, Catherine. Oh, we got a smart one here. Yeah, it's buyers buying is aggression, right? Buyers buying is aggression. It's where the sellers stop selling. Sellers perceive this price to be too low or below value to continue to sell it. In fact, I would venture to say that this green line was first created not by buyers buying at all. Instead, I would say this is, if I can find the pen, that this is actually sellers buying. But yeah. Okay. Boy, something's jumbled here, and I don't know why. Anyway, there's two sides to every trade in a two-sided auction. There's a buyer and a seller. There's plenty of buyers down here. There's no shortage at this price. Price can't go any lower because no one wants to sell down here. There just aren't enough sellers at this level. So when the market runs out of sellers, right? If there's no more sellers and the market needs to find more sellers, which way should it move? Up, right. But we also know that when the market is balancing, it tends to do what? Does anybody remember? Maybe this will refresh your memory. The market tends to move to size when it's not trending. And we just said plenty of folks would like to buy down there. That's where the size is on the buyers. There aren't enough sellers. So which side, buy or sell, has the greatest size? Right, the buyers. So the market goes down first. It goes down to size first. In a non-trending market, when the market reaches order imbalance, the first thing it does is moves to size. And that's what happened there. The market moved to the heavier side, the buyers. And what happened? Did the market find some sell orders down here? Who's selling down here? Okay, I've totally lost you and it's my fault. Okay. The market did find some sell orders to match up with those buyers. It did. There may have been some initiative selling. Maybe if you saw this as a break of support and got short. But there's stops. When a stop's touched by price, a stop turns into what kind of order? Well, okay. If a stop gets to it, exactly, it turns into a market order, and the market order becomes a market order to sell. So there's probably still plenty of buy orders down here. But once these stops get hit, that's it. Now the market's really out of sell orders. It's finally and officially exhausted all of the market's sell orders. So now there's nothing left for the buyers to buy. Now price can move up. And I'm going to skip ahead because somehow, yeah. Okay, this is going to make more sense, I think. To find more sellers, the market's got to move up. So the order flow in a balancer value area tends to cycle like this. In fact, just forget that whole previous slide. We're in a bull market. So let's assume price came upward into this area. So at the beginning of this chart, the winning trades are longs. Price reaches their profit targets. We're over here with these first red arrows. First red arrows over here. So at the beginning, the winning trades are longs. Price reaches their profit targets, triggers their resting orders to close. And if buyers are taking profits, are they going to keep buying up here? No, they're not going to keep buying. They're done buying for now. They're taking their targets. Buyer aggression wanes as buyers take profits. So the market orders to buy at the ask start drying up. And there's only one kind of buy at the ask buyer left up here. And we kind of just talked about it on the last slide, although I really messed up telling you about it. But who can tell me what buyers are left way up here? There's just one kind of buyer left. All price has to do is touch it, and all their stops turn into market orders to buy. Right. Very good. All the folks who saw this as the place the longs would take profits and jumped right on in there short, thinking price would just tap it and roll over. Those early shorts, their stops are going to be up here. And that will be the last of the buy orders. Longs take profits, short stops taken, buyers exhausted. I think this is going to be a much better slide for everybody. Okay, now the market is truly out of buyers. Which way does the market have to move to find more buyers? Yes, the market has to move down. Yeah, somehow this is just much better this way. So when the market moves down, looking for more buyers, what do the traders who didn't get filled up here, these poor guys, anybody who didn't get their fill to take their profits up here, what do they start thinking? Or they thought price was going to keep going higher. Yeah, they're probably thinking it might be time to close. So some of them start taking profits, or what's left of them. And some of them are going to use market orders, and some of them are going to be slightly more patient traders, and maybe they'll scooch their limit orders a little lower and wait for price to come back up when it retests that line. So what's going to happen when these early buyer types start buying and press price back upwards? Yeah. Those early buyers, just like those early sellers, that their market orders are going to hit a wall of limit sells. And there aren't enough buy market orders to satisfy the longs to close. And I mean, look at it. These are just wicks up here. There's little, touched it. This isn't a lot of trades. So there's still a lot of people who want to get out of their longs up there. You think by the time price comes up here and starts doing this, those people have figured out that price isn't going up anymore? Yeah, selling immediately. Exactly. They finally realized price has definitely reached a stopping price. They're entering market orders, and they're selling into the bid aggressively now. That's seller aggression. And it gets fueled by those early buyers' stops right here. Their stops get taken, and there's enough of these guys that want out. They start to chew into some of the resting orders that are down here below to buy. But price reaches a level the sellers find unacceptable to sell at anymore, so they stop selling, right? Say, this is too low. So there's not enough sellers to exhaust the supply of the passive resting buy orders on the dome ladder. So price gets pushed back up. And these longs get in, and their stops are, where's that mouse? Their stops are, probably right around here. So they get long, and price comes back up again. Back to this previous area of profit taking. Any longs who waited patiently for their resting limit orders to fill are going to finally get satisfied. Yay, happy dance. And price pulls back a little, but these buyers see what? What's that? That's a higher low, right? It's a long. So more of them pile into this trade. New buyers see opportunity. They enter market orders to buy on both of these pullbacks. And but again, they're unable to overcome the limit sells waiting for them up here. So the buy at the ask orders come up to resistance. But this next time, it's a little different, right? Look at this. They get rejected instantly. That's one wick. Boom. Says, no ma'am. Slam back down. Anybody want to take a guess? What's different this time? What's different here? Is this longs waiting for their profit targets to fill? I would say that wick is created by aggressive market orders to sell at the bid. Those are genuine short sellers. Um, this is the next amalgamated law in action. History repeating and the level becoming easier to see. This level is getting recognized by more traders as resistance now. And what happens? They hit. The sellers are being aggressive. They're selling into the bid, selling into the bid. They take out these people's stops. They take out these people's stops. Boom. What happens down here? No more sellers. Excellent. Daniel, frequent trader point right there, or 2, or however many we're giving out nowadays. Good job, Daniel. Okay, very good. No more sellers. So, market's out of orders to sell at the bid. Where does the market have to go to find more sellers? Yep, up. You got it. Okay, so let's see. And it just does it again. And by now, I would say that that's support, and that is definitely resistance. So, how's everybody doing? You hanging in there? I'm sorry, I know I got a little bit jumbled up, but I think we're in better shape. We're good? You all hate me now? Yeah, I'm sorry. I know this is a long one. So, good. Okay. Now, this next bit is a little bit of a mind bender, or at least it was for me at first. So, what's really creating support and resistance? Is it really buyers buying like we've all been told? It's not, is it? Buyers buying is aggression, and aggression creates trend. Support is not created by aggressive buying. Support is actually created, and this is just so weird, it's created by the absence of seller aggression. And resistance is created by the absence of buyer aggression. Not enough market orders to sell into the bid and eat through those passive resting orders to buy, or not enough orders to eat through the ask and eat through all of those passive orders to sell. It's just that simple. So aggressive buying at the ask creates what? Trend, right? Okay. A lack of aggressive buying creates resistance. Aggressive selling. Let's see, are we there? Let's see if I've got this right. Yes, okay. Aggressive selling. Right there. See that flashing red arrow? Aggressive selling at the bid creates what? Yes, downtrend. What do you get when neither side is aggressive enough to overcome the resting orders of the other side? Neither side's aggressive enough to overcome. Exactly. Balance, value area, equilibrium, ping pong, sideways channel, accumulation, distribution, trading range. Call it whatever you will. That's the value area. And then we have this, oh my God, this little pink line, which is the most popular price, the volume point of control, called the VPOC for short. So next amalgamated law, I got to pick up the pace on this. First of all, everything I just showed you happens over and over and over. Rule number 1, balance, imbalance, balance, imbalance. Every time frame, markets are fractal, over and over, value area to value area, every time frame, value area to value area, this little bounce around action. This is what happens most of the time. Now, not always just one value area in one day. Sometimes it'll the day will involve 2 or 3 value areas. And we'll get into all those situations in the next class. But really, it's a game of Pong. History repeating, support and resistance. Now, I want to get into this volume profile thing, but first, I've got to add a few words of warning. Every once in a while, the market goes into pure trend mode. I know you've all seen it, the kind of day when the market just takes off right out of the gate, never looks back, and one side is just so aggressive. The directional market orders never stop. The market can't exhaust them, and nothing. It doesn't even pull back till the end of the day. And there's top or bottom pickers keep trying to fade the move, and it just fuels the move even more because they're filling with their entries and they're filling again with their stops. When the market is in pure trend mode, it's just going to rip through every value area in the way. So remember, everything we're about to cover is useful most of the time, but if the market is trending hard, forget about it. Don't even think about these, okay? At least not on any time frame smaller than the daily on a trend day. Okay, so this is a volume profile chart with the time-based candlesticks. Let's see. Oh, I've got the pen. Look. So this thing here, this giant new thing that you haven't seen before, that's the volume profile. Profile, I guess, because it's sideways, vertical. And what it's showing us is volume on the horizontal. Instead of being, volume on the vertical. Instead of being on the horizontal axis, which shows us how much volume in each certain amount of time, this volume profile shows us how many contracts traded at each price. So I like this because at one glance, you very clearly can see where most of the trade took place. Well, guess what? That's the value area. I think it's a lot cleaner than trying to define support and resistance with candlesticks. And for what it's worth, it shows you the most popular price. That's this pink line here. This one. That's where it's like the most popular price. That's the prom king of price. It's where the most contracts have traded at. Okay, so volume profile is sort of an offshoot of the TPO profile, which is what I use more. I find it to be a lot more precise. They're both useful. We'll cover both. I have both on my charts. But, just compare how neatly the volume profile defines this value area compared to the candlesticks. If I hadn't drawn those green and red lines there, it might not be so easy to really pick out fair value and what's below value and what's above value. And so, the volume profile makes it easy to see price at value. And if you remember our auction, what do most people want to do when price is below value? They want to buy. And if it's above value, they want to sell. So having something that you can look at real quickly might help you avoid buying the top and selling the bottom at the very least, right? I mean, no one wants to be top tick Tilly or low tick Louie. And market internals will help you recognize when it's a legitimate breakout or not. That's going to be part of one of our next classes. So it won't be long till it all starts coming together. In the meantime, let's knock out a couple more rules really fast so we can work a little bit with TPOs and the volume profile, and we'll be ready for the next class. So why am I looking at this with my scribbles? Okay. I must have clicked the wrong button. Okay, so history repeats itself. This is pretty simple, right? I mean, it all comes down to support and resistance. Market moves from one value area with its own support and resistance to the next value area with its own support and resistance until it runs out of orders or it's pressured by conviction, and then it goes to the next value area and tests its support and resistance. Usually the first time it tests an area, it's get rejected. If it doesn't, price will probably go to the other side of that value area and then get rejected. And if it gets rejected on the first test, it'll probably go back and test it again. It's all about market structure how it gets there, the approach and the market internals. And one other thing about this particular history repeats itself when support and resistance on a 10-minute chart is also support and resistance on like a 60-minute and the daily. It's probably going to hold as support and resistance, at least the first time price touches it. In fact, the first time odds are usually in favor of a reversal. And if the weekly or the monthly also has that area as support or resistance, you can pretty much count on it being a reversal, because a larger number of traders are going to be interested in those levels. When a daily support or resistance comes into play, you're going to see some swing traders enter trades. And if it's the weekly or monthly chart, you can pretty much count on some institutional action. That means more money, more traders are going to enter or exit, which means the reaction to those levels that have confluence across different time frames, multiple time frames, is going to be a bigger reaction than a plain old intraday level, say, on the 15 or 30-minute chart. Which brings us to another amalgamated law. I don't know if you guys have ever heard this, but this is something that drove me crazy for a long time. Have you ever heard the bigger time frame rules the smaller time frame? Yeah? Some of you? Okay. Well, okay. Yeah. All right. Yeah. Okay. Cool. Most of you. Okay. So type in a 2 if you've ever heard that trend develops from the inside out. All right. I'm putting you guys to sleep. Okay. It's all right. Okay. It means trend begins in the smaller time frame and works its way up into the bigger time frames. I mean, it has to, right? The trend of the big time frame can't change without the smaller time frame changing first, right? So which time frame is really in control? This drove me crazy. How can the bigger time frame rule if the trend starts in the smaller time frame? And I don't know about you guys. This messed with my head. The problem is it's like oversimplified to the point of being meaningless. So here's what I think they were trying to say. The large time frame rules. Who trades the large time frame? The daily, weekly, and monthly charts. We just talked about them, right? Day traders, swing traders, bigger money, like institutions and funds, right? Bigger money trades those time frames. And the goal is to sell high, buy low, sell high. So bigger money will most likely be entering the market long at weekly or monthly support. Anybody disagree? Okay, I'll take that as a no. So is it a good idea to trade with bigger money or against bigger money? With it, right? We always want to be on the same side as big money because they're the only ones with enough capital to sustain control and drive the market longer term. So if big money is trading off the weekly and the monthly time frames and big money wants to buy at support and sell at resistance, huge market moving buy and sell orders can be resting at support and resistance levels on the larger charting periods like the weekly and monthly charts. So areas of support and resistance on the weekly and monthly periods is more likely to hold and create a tradable reaction like a reversal than support and resistance on a 15-minute chart or a 512 tick chart, right? You guys with me? Yes, awesome. Okay, so swing traders, they enter and exit off the daily and hourly charts. Can we agree that when swing traders enter and exit the market, it will affect the market in a way similar to when the bigger money enters, but not as strongly? It will not be as sustained a move? All right, good. Awesome, you guys. That's how the larger charting periods rule. Larger traders use larger trading charts, and when they enter, they tend to accumulate and hold over days, weeks, months in anticipation of larger gains than day traders. Now, when you're trading off a smaller period chart like the 15-minute or the 512 tick, those big support and resistance levels from the weekly or the monthly probably aren't going to be really obvious on your charts. It's going to be too far back in time to see on smaller time levels, smaller time frames. But when price approaches a support or resistance level from that larger time frame, the odds favor strong, sizable reaction because big money's got their orders sitting there, right? So if the level holds, there will be an immediate stop triggering move in the opposite direction. Or if it breaks, there will be a swift, powerful stop triggering continuation. And big money is called big money for a reason. The amount of capital that enters or exits the market with big money, it's going to move price. And, you know, some swing traders too. So that's, but the turn in the trend, right? Where are you going to first see it? It's going to begin on that smaller time frame. So the big money rules the larger time frames, but the trend still starts on smaller charts. And we sure don't want to trade against big money. That's a great way to get chopped to pieces. Sometimes the support or resistance is broken and tested intraday, but it's regained by the close, and that could be a sign that big money sentiment has changed. I mean, if it's not regained by the close, that could be a sign that big money's ideas has changed, and it might be that's going to be first visible in the smaller time frames. That's the trend from the inside out part. So a healthy trend doesn't move straight up or straight down. A normal trend is going to move in thrusts and pullbacks. It's a little sexy, which brings us to the next law. A normal market hates a straight line. Think of this as law as a modernization of the old Dow theory. A trend in motion tends to stay in motion. Should kind of sound familiar to you if you've watched Jeremy's Dow theory webinar. Pretty sure everyone knows this, but a normal or healthy trend doesn't move straight up. Let me get to this. Here we go. I mean, this is normal market development. Price will do, come on, pen. Price does this, and then it does this, and it sort of balances a little bit, and then it continues up. The mouse hits something. That's normal price development. We get an up move, we get a pullback, we get a continuation. There's something on my table I keep hitting. That's normal price development. These pullbacks offer entries for new buyers, the opportunity to add to existing long positions, and it builds support along the way as it moves higher, right? Each one of these pullbacks, that's fresh support. People can get in here, they can put their stops here, and trust that level to hold. It keeps the buyers interested. This kind of trend tends to keep going because the market can only fall so far before buyers see a new opportunity to get long. Okay. But so healthy trends tend to end in, and this is a healthy trend. Let's see if I can get one drawing that's good. If I can find the mouse. There it is. Okay. So up. Oh, come on. Up. A little bit of a balance. More up. A little bit of a balance. I'm getting a little delay here. A little bit of a balance. Healthy trends tend to end in balance. They don't, a healthy trend doesn't do this. Not without news. That takes news. And anything that goes straight up like this, it's probably going to come straight back down like this, and then some. So let's move on. Oh, good. We covered this. So normal healthy trend, pause, build supports along the way. Some traders call it the grind. Normal trends end at some form of logical support or resistance, and then they just sort of balance for a while. These are some of the key reference points for support and resistance. Just in case you were wondering. Stupid pen is driving me crazy. All right, key reference points for support and resistance. Some of them you know, some of them you don't. We'll get into all of them in the next class. Just don't try to pick a top unless there's a reason for it to be the top, a stopping point. Just like an intersection will have a sign, it could just be a stop sign, or it could be a red light. Sometimes it's a roadblock. But so even those straight up moves look powerful and impressive, those straight up moves are the most fragile, the most likely to end in a V. Healthy, strong trend doesn't look as impressive on the chart, but it's built support beneath it the entire way up. Those zigzaggy trends are the most likely to continue, and they usually end in a new balance area, not a V. Here's a couple of parabolic moves. I bet you guys can name these two 2016 events. What's this one here back in June? Anybody? Anybody want to make a guess on that? It's Brexit. It's like, okay, it's Chicken Little, right? Oh no, Britain's leaving the European Union. The sky is falling. What are we going to do? Oh, wait, it's not going to happen tomorrow, is it? Oh, everything's fine. La da 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 da. And this one in November. Anybody want to make a guess on this? Yes, very good, David. That's the president election. That's election night. Oh no, Hillary's not going to be president. What do we do? Ah! Oh wait, we're going to have a president. It's okay. Ah! It's like nothing happened. Ridiculous, right? And by the way, both of these events, the big gains were at night. Only the futures traders and Forex traders were able to get it. Brexit offered like a little bit of regular trading hour opportunity to the brave, but the opportunity created by the election that opened and closed before the regular session began. Only futures traders got it. So, look, that's enough behaviorism for now. When the market freaks out, if we're in a bull market, it's a buying opportunity. Take it. Just be careful. Don't get in too big too soon. Okay, so that was market excesses in one direction lead to an opposite excess in the other direction. This is good old Bob Farrell. Price discounts everything, but it's not perfect, which means, look, we're living in the age of information. Info reaches more people faster than ever before. The market has become incredibly reactive to new information, and it makes it overshoot, like overreact. It pushes price past support or resistance, only to slingshot back the other way, equally hard and fast. And electronic trading makes these reactions even faster and more dramatic. Think of it like when you were first learning to ride a bicycle. It was really hard to find the balance in the beginning, right? You'd lean too far one way, then you'd overcompensate and lean too far the other way. And gradually the overcompensations would get smaller, until you were able to find the right balance and ride the bike. So price action, I did trade election night. Price action, a reactive market, is similar. The news hits, the directional drive is forceful. Trap traders exit, momentum traders enter until the market reaches order exhaustion. And then the whole thing reverses with just as much force. The momentum traders are trapped, get stopped out. Pardon me. Or they whole, so it creates V bottoms and tops. Price discounts everything, but not efficiently, not perfectly. And those efficiencies create great opportunities like those the day after Brexit, or on election night. Some folks call them black swans. But in a bull market, like I said, we are right now, for the record, real, true, honest-to-God bear markets are only caused by recession. Black swan events, pretty much buyable corrections every time, unless they're caused by a failure in the global economy, which, in case that a failure in the global economy, that is the beginning of a recession. Okay. And remember, I'm talking about futures only, not stocks. Certain black swan events can crush a stock permanently, but trading stocks is trading brands. Futures trade the building blocks of global commerce, that the commodities, currencies, economies of the world. So the misfortune of one company or the other is immaterial. All right. Let's slow down a second, give our brains a couple minutes to digest. In the beginning, God created. Okay, here we go. Futures contracts were traded through open outcry. You guys know this. Basically, everybody was yelling at once. It was like an auction without an auctioneer. They put the price up on the chalkboards. Trading floors got crowded. They were using hand signals. Prices on the scorecard. You've seen these pictures, hands in the air. These guys placing orders. They write them down on those tickets. I know you guys have seen all this stuff before, but I'm wondering, have you noticed in any of the pictures of the trading floor, anybody see anything missing? These guys, something we use every day, and the answer is not a computer, but there's something none of these guys have. I mean, how are these guys tracking price? Right? They've got no charts. All they've got is the bid and the ask up on the spread. Pretty impressive, huh? All those ex-pick traders and market makers charging big money for trading rooms and webinars, they got to be super geniuses, right? Okay, well, maybe not. See those order tickets everybody's got? Each of those guys has probably drawn a version on the back of one of those. Oh my God, I just looked at the time. You know what, guys? We're going to wrap this up really soon. I apologize. Anyway, charts. They didn't have any charts. And we'll end with this. Point and figure charts. This is on the back of every one of those tickets or on their arm or a cocktail napkin. They would draw one of these. And we will come back to this on the next class. I apologize for how long this ran. I was trying to give you guys time to like think and answer questions, and I think that slowed things down, not to mention I just mucked things up now and then. Well, how was that for a first class back? Oh, give me a second. Let's stop the recording. I'll grab a sip of water. And if anybody has any questions or is confused, I'll help you. I'll be right back. Question I see here is from Dan Nugraha. And yes, I do trade futures at night. I love to trade futures at night. Oh, God, you guys, I'm sorry. I wanted to really, get us through this so we could move forward fast and get to the really fun part. And I tried really hard. I tried really hard, and I looked up and realized, oh my God, it's been like 2.5 hours. I think that's plenty. We're probably all brain dead. No wonder I'm stumbling and I'm sorry. Please. Does anybody have any questions? Okay, well, thanks, you guys. That's sweet to hear. Sadly, I think perhaps I may have been ambitious trying to get everything into just 4 classes in this last round. I don't know. I'd have to talk to Jeremy. We might extend a little just so we don't kill ourselves. But we'll see what happens with that. You're welcome. No questions, huh? Everyone just wants to go. Okay, everybody. I'm calling it. All right. Sleep well, everyone. Ciao for now. Good night.